During 2023 and 2024, recessionary talk significantly subsided, with US economic data pointing to expanding US economy and strong labor markets. Investors stopped believing that the economy would slump, and instead they concentrating on searching for opportunities to explain the ongoing growth. With this, the stock markets were consistently creating new historic records. Financial conditions began to ease significantly, stimulating the economy, and businesses are increasingly optimistic, leading to an increased investment in response to the strong demand as shown by statistical data. As I have explained in my previous videos, the nature of this economic expansion seems rather superficial and not rooted in real economic fundamentals, but rather it may be a result of intense fiscal stimulus. All that has happened is that we have moved back in cycle due to government interventions. Although it does not seem like recession should arrive anytime soon, the probability of it is actually increasing with rising inflation, something that many investors don't understand. I'm here to give you this piece of information beforehand, so if and when it comes, you will not be surprised as the rest of the market. Surely you heard about the business cycles. The economy tends to go through the cycles of expansion and correction. It is very natural and actually healthy economic dynamic. The reason why we have those cycles is simple. Many biological organisms in the nature are going through various cycles. Economy is nothing else than a bunch of those organisms, aka humans, interacting with each other and with surrounding environment, which is also cyclical. Take weather for example. So it naturally creates cycles that are influenced by numerous factors, as this chart shows. There, the cyclicality of economic growth is evident, coming as far back as 1950. On average, recession hits every 6 to 7 years. The last real recession we had was during the Great Financial Crisis in 2008. Now, why do I say real recession? Of course, official definition of recession says that 2 quarters of negative GDP growth is a recession. But for investors, I think this definition is useless. Now, most investors associate recessions with deep market corrections. Yet take for example Germany. Right now, Germany is, according to this official definition, probably in recession, but its stock markets are breaking new all-time highs. This is not only the case for Germany, but also for many other European countries. But wait a minute, how can stocks rally when economy is going through the recession? That doesn't seem right. Well, that's why I'm saying official definition of recession is quite useless. I instead define true recession as not only slump in GDP growth, but also in labor market. Now that is the most important and painful element of recession, the labor market, when people are actually losing jobs and unemployment grows. So looking at this chart of German unemployment, you can see even though GDP growth is negative or zero, unemployment didn't change too much. That is why German economy doesn't necessarily feel like it's going through the recession, and that is also the reason why German stocks are able to fly high. So for investing purposes, recession that correlates with stock market sell-offs is the one in which unemployment skyrockets. Unemployment is what stock markets truly care about, not GDP growth. That is irrelevant. Obviously, nobody cares if economy as whole is not growing if everybody has a job and their wages grow. While these true recessions are painful, they are necessary cleansing mechanism for the economy, like your skin for example. It is constantly being generated and some layers are constantly dying. You need to shed those dying cells so the healthy cells can thrive and breathe. Now that you understand what really matters to markets, let us take a look at where we are in the context of the cyclicality. The last real recession hit in 2008 financial crisis. On average, every 6 to 7 years you should see recession, right? This interval may be longer sometimes or shorter. It is an average after all, so the next recession candidate after 2008 is year 2020, when the pandemic hit and that would be 11 to 12 years after the great financial crisis in 2008. The pandemic recession in 2020 definitely qualifies as true recession, as unemployment in the United States skyrocketed to 15%. But there's something special about this cycle. Looking at this chart of US unemployment, you can see that after each recession, the unemployment peaked with parabolic growth, and then it took gradual stairs down, and it took years to normalize unemployment. This is the healthy way where economy gradually allocates labor force to where it is truly needed and gives time for businesses to properly allocate capital. So as you can see, those red rectangles are fairly wide. Now compared to 2020 recession in the green rectangle, where unemployment parabolically skyrocketed, and then it took the elevator down right away. So in this case, the process that normally takes years, sometimes even decades, happened in only 2 years. Now, does it sound artificial, weird, or unhealthy? Well, it should, because it is unhealthy. What you see in green rectangle happened because government and Fed decided to intensely stimulate the economy via quantitative easing and various fiscal stimulus packages. This boosted the demand by essentially giving people and companies free money, and thus companies had suddenly a reason to keep hiring new employees. The problem here is that this gradual process of labor allocation was absent, and labor instead was allocated in an inefficient and artificial manner. Therefore, you could say that the real recession was prematurely interrupted this time and didn't take place as it should have. This will cause problems in the future, as this costs the government huge amounts of money to sustain and makes the economy inherently less efficient, which is going to act as a long-term drag until true recession process is allowed to take place. But then obviously, due to the accumulated inefficiencies in the economy, it may result in sharper and more negative outcomes. Not only did this government intervention lead to inefficient labor market allocation, it also created a problem of high inflation. Now you might think that we have conquered inflation as it is hovering nearby 3%, but be careful. Historically, whenever inflation has risen too high, like it did during the past years, it took a real recession to put it down sustainably to 2%. So although there is chance this time that a soft landing will be achieved, where economy doesn't slip into real recession and inflation will settle down to 2%, history tells us odds of this happening are rather low. In 2023 up until 2024, this seemed like it truly worked. Inflation came down month after month, while US economy grew solidly. However, come 2024, this story is worsening again as inflation stopped falling. It actually is consolidating around 3%, almost as if it was ready to go a bit higher again. While it may not sound like a problem, the persistent inflation actually may create one, because now the Fed cannot lower interest rates. You might say also, whatever, in 2023 US economy grew in spite of high interest rates, so why should I care? Well, because this growth was fueled by extraordinary fiscal measures, and the cost of this policy is huge increase in government debt, displacement of capital in bond duration structure, and higher inflation. With Fed unable to lower interest rates and government spending money like a drunken sailor, we will probably enter a period of stagflation. I believe the current Biden administration is highly motivated to stimulate the economy because they need to be victorious in an upcoming highly polarized elections in November 2024. Now, it is not some kind of conspiracy, it is actually a statistically proven fact that governments increasingly stimulate economies prior to elections. And during this election cycle, Biden administration was fortunate enough to have access to huge amount of leftover funds from the last quantitative easing that are being used all along to cancel out the effects of higher interest rates and quantitative tightening combined, and even deliver growth on top of it. Even though I see real possibilities of strong stimulation of financial markets prior to election, it is also true that high inflation lowers the chance of Biden re-election. People are being squeezed by growing prices of basic needs. Therefore, it may be that his administration may now decide to curb the inflation by allowing bond rates to rise, markets to fall, and then shortly prior to election, it would make sense to prop up the markets again, since you don't care what happens to inflation after the election. Of course, the question is, can they pull it off in this manner? If high deficit spending ends this year and interest rates remain where they are currently, recession is a high probability outcome. It is becoming less questionable that Fed will have to stand its ground and avoid lowering rates this year to avoid further supporting inflation growth. Whoever wins November election, the question is, will they be able to continue with this hugely generous and unsustainable fiscal policy that delays the economic slowdown and feeds inflation growth, or if government becomes less supportive with its policy and rates are still high, what will prevent US economy from falling down the recession pit? Will natural economic growth and positive momentum from previous years be enough to stave off the true recession for another few years? It's hard to tell, but obviously this makes recession much higher probability than investors assume nowadays. Now, the exact mechanism of recession trigger would probably take place via growing government bond yields. These were so far held artificially lower by Biden administration. Janet Yellen, the current US Secretary of Treasury, chose to predominantly emit short-term bills, which decreased supply of long-duration bonds and therefore artificially depressed yields on these bonds. Now, these yields are very important because they serve as benchmark in setting stock prices, in setting mortgage rates, borrowing rates, and it also directs where capital will flow, if it's going to be out of the stock markets or in the stock markets. She could keep long-term yields lower so far thanks to the excess liquidity that was created during the pandemic quantitative easing episode, but this reserve is growing thin, as she already has sucked over $2 billion from the vault, with only $500 million remaining there. So simply said, it seems like the United States will either restart quantitative easing in 2025 and 2026, or it will have to face true recession. However, restarting of quantitative easing while inflation is not controlled for sounds like a really bad policy. So according to this analysis, the true recession may be necessary either way to normalize the economy and inflation in 2025 or 2026. Hopefully this was useful, and try to keep this in mind as you enter this new world. What is happening now is pretty much unprecedented in our lives. If you want to learn about why gold prices skyrocketed or why Fed is losing its credibility, please watch the suggested video. Take care.